Welcome to The Explainer. We're jumping right in today because we've got a massive shift in the global accounting landscape to talk about. Today, we're unpacking IFRS 18. This is the brand new accounting standard that is absolutely going to reshape how companies report their financial health. And when I say global, I really mean it. IFRS accounting standards are effectively a global financial language required by companies in more than 140 jurisdictions around the world. So when a new standard like IFRS 18 drops, it sends ripples across the entire financial ecosystem. Here is our roadmap for today. We'll start with a quick welcome to IFRS 18, look at the shift from IAS 1, and break down the new profit subtotals. Then, we'll define management-defined performance measures, explore the new aggregation principles, and finish up by getting you ready for 2027. Section 1, Welcome to IFRS 18. Let's establish our baseline right here. Right out of the gate, here is the absolute bedrock of this new standard. Under IFRS 18, an entity is required to present a complete set of financial statements at least annually, but it doesn't stop there. It explicitly demands comparative amounts for the preceding year. And yes, that strictly includes comparative amounts in the notes as well. This foundational rule makes sure that anyone looking at a company's financial health has an immediate, apples-to-apples baseline from the prior year to evaluate growth, stagnation, or decline. It's all about total transparency from the ground up. Moving on to Section 2, the shift from IAS 1. So you're probably asking the exact same question auditors, analysts, and accountants everywhere are asking right now. What happens to IAS 1? I mean, this standard has been our guiding star for decades. It was adopted by the International Accounting Standards Board way back in April 2001, and its roots literally stretch all the way back to disclosure standards from 1975. Well, the short answer is that IFRS 18 officially replaces iOS 1. But they didn't just toss the whole playbook out the window. Actually, scratch that. It's more like a strategic reorganization. The board heavily focused IFRS 18 on improving the statement of profit or loss. For the broader, enduring rules that still work perfectly fine, they kept some paragraphs right inside IFRS 18, and they meticulously moved others over to iOS 8, which covers basis of preparation, and IFRS 7, handling financial instruments. So think of it as an evolution, not a total erasure. The spotlight is just firmly on profit and loss now. This evolution brings us to the core framework of the new standard. IFRS 18 uses what I like to call a rule of three to drastically improve financial reporting. We've got three distinct pillars: presenting two new defined subtotals, disclosing management-defined performance measures, and adding new principles for aggregation and disaggregation. We're going to unpack each of these right now. Which brings us to Section 3, New Profit Subtotals Explained. Here we go, the two new mandatory defined subtotals that entities now have to present. Number 1, operating profit. Number 2, profit before financing and income taxes. Why does this matter so much? Well, you know how historically companies had a lot of leeway in structuring their P&L statements. It made comparing the actual operating performance of two companies a total nightmare for investors. By legally mandating these specific subtotals, IFRS 18 forces a standardized, crystal-clear view of a company's pure operations. It completely strips away how they finance themselves or what their tax burden looks like, giving you the real, unvarnished picture. Section 4 takes us to the second pillar, defining performance measures, or MPMs. Now pay close attention to this strict definition because it carries a ton of regulatory weight. Management-defined performance measures, or MPMs, are subtotals of income and expenses that are not specified by IFRS accounting standards, but that are used in public communications to communicate management's specific view of performance. So what's the real takeaway here? We all know companies love throwing around their own custom metrics in press releases and earnings calls, things like adjusted EBITDA or core earnings. IFRS 18 is stepping in and saying, hey, that's completely fine, but you must now explicitly disclose these measures inside the financial statements themselves. And yes, they are subject to audit. It places a massive fence of transparency around what used to be a bit of a Wild West in corporate communications. All right, Section 5, Aggregation and Disaggregation Principles. This third pillar solves a massive headache for everyone reading these statements. Have you ever looked at a P&L and seen a giant, vague line item just called Other Expenses and thought, what on earth is actually in there? IFRS 18 fixes this by adding strict new principles for aggregation, how you group things together, and disaggregation, how you break them apart. It makes sure that financial data isn't haphazardly lumped together just to hide unflattering details, but it also stops you from breaking things down into so much meaningless trivia that you completely lose the big picture. The end result? Way more useful, relevant, and readable financial statements. Section 6. Preparing for 2017. We know what the standard does, so let's look at the timeline. It's urgent, but it's totally manageable. We've been on quite a chronological journey. Like we noted earlier, April 2001 was when IAS 1 was adopted, governing us for over 2 decades. Fast forward to April 2024, and the IASB officially issued IFRS 18. This kicked off a transition window pointing right at our impending enforcement date, January 1, 2027. For annual reporting periods starting on or after that date, IFRS 18 is the mandatory law of the land. But here's a massive opportunity for all you proactive folks out there. While the mandate is a couple of years away, earlier application is expressly permitted. If you're ready, you have the absolute green light to adopt these standards right now. It is a fantastic way to signal to investors that you're ahead of the curve and fully committed to the highest levels of transparency. 2027. Go ahead and stamp that date into your memory. I know it might feel like it's a little ways over the horizon, but think about it. Updating accounting systems, reevaluating how management defines its public metrics, rethinking the aggregation of your ledgers, that whole shebang takes a tremendous amount of time and planning. Which leaves us with one final absolutely vital question. Is your organization truly ready to open its books to this brand new era of financial transparency starting on January 1, 2027?